owns the most property here in London?
Him. It's a no-brainer, mate.
I was kind of hoping you get it wrong, to be honest.
You know, this country is sorry, but
Yeah, no.
Investing in property is hard. A lot of people will make you think that it's an easy thing. It's a get rich quick scheme. It's not. So don't let the online gurus fool you or trick you into spending a lot of money on courses or personal coaching. Yes, you can make money in property, and yes, it is a good way to build generational wealth, but it's not a get rich quick scheme, and you want to make sure that you surround yourself with the right people. So let me just share a few things that I know about getting a buy to let mortgage. Now, what is a buy to let mortgage? If you think about it this way, over 1 in 5 households in the UK are renting. So they rent privately. So there's a huge opportunity. You've even heard it being called generation rent. So there's a lot of people renting. So there's a really high demand for rental property. So it is something that you should look into and should consider. UK house prices have increased by 63% over the last 10 years. And despite the economic cycles and the vicissitudes of property prices going up and property prices going down, in the short term, in the long term, property prices tend to go up. So you may be one of those people that's been considering going into property investment or going into buying buy to let properties, but you want to understand how it works, how a buy to let property mortgage works, how you get one, what the criteria is, and we're going to go through that with you right now. Always remember that your home may be repossessed if you do not keep up your mortgage payments. So what's a buy-to-let mortgage? Simply put, a buy-to-let mortgage is a type of mortgage that you would take out for a property that you want to buy, but you don't intend on living in. So you want to rent it out. You want to purchase it for the purpose of other people living in it. Now, it's important that you get the right type of mortgage. Banks are not stupid. Banks do know what you're doing. So always take the right type of mortgage. I don't see why someone would take a buy to let mortgage and live in it, because you're usually going to have to pay down a larger deposit. But people do try to manipulate schemes, and I would strongly advise against that. Remember, the bank is not your friend, but also the bank is not your enemy. If you have a relationship with your bank where you're saying, my bank is great, or you're saying, my bank is horrible, probably something has gone wrong at some point. Because if you take out a mortgage and you pay your mortgage by direct debit every month, never miss a payment, you'll have no relationship with your bank, because they'll just take the money every month as agreed, and then at the end of that term, you'll own the house. So what are the pros of a buy to let mortgage? So investing in property can be a smart way to build your long-term wealth. It can be a way to build a retirement pot, and a rental income can help cover the cost of the mortgage payments, either just for the property that you're living in, and potentially if you have a residential property, some of the income that you're getting from your buy to let property can help pay your mortgage. And property does tend to appreciate or grow in value over time. So it's not a short-term plan. Investing in property is not about, I'm going to flip a property and make a bunch of money and run off. Some people do that, and it is possible. But if you're a first-time investor, you want to make sure that you understand what all the benefits and what the advantages are, and also the things that could go wrong. Because the people trying to sell you a course, 9 times out of 10, aren't going to talk to you about the things that can go wrong. They're simply going to tell you about the things that will make you want to buy into their course. I'm not knocking people who do property courses. I know people who do some fantastic courses and have helped people make a lot of money. Those type of people tend to be few and far between. The ethical people that are going to tell you this downside and are there to make sure that you and your family benefit Those people are few and far between. You'll find more people that are just trying to get you on their course, and if you make money, that's a bonus. If you don't, they've already made their money. The cons, the downside. Buy to let is not without risk. So you have to consider the fact that if you're getting a buy to let property, you're usually going to have to pay down around 25% deposit. Whereas with a residential mortgage, sometimes you can get away with a 5% deposit, and there are even lenders that will lend up to 99%. With a buy to let, in most cases, you're going to need to pay down a 25% deposit. Some lenders will even request more than 25%. Keep in mind, everything that I'm talking about today is the general rule. You will find that there are always lenders that work around the edges. But just as a general rule of thumb, if you're considering getting into investment property and you need a buy-to-let mortgage, think about that 25% mark. Also consider what your situation is, and remember that you should be going into this as an informed consumer. What you don't want to do is go into this because you saw some guy on YouTube or some guy on TikTok that's saying that this is a quick way to make money. You want to make sure that you remember you may get the property and you may not be able to find someone to rent it. The bank does not lend to you contingent upon it being rented, whether it's rented or not rented. You need to keep in mind that you need to pay your mortgage every month. There may be tax implications. So having that buy-to-let property may have some tax implications. And you also want to make sure that you speak to an estate planner, that you can situate your property and your finances in the right way. I mentioned a little bit about deposits. So for a buy-to-let mortgage, you're typically going to need a 25% of the purchase price. You may need up to 40%, you may need less. The larger deposit is usually going to give you access to better interest rates, but don't let the interest rates fool you. Quite often what you will find when you're looking at buy-to-let mortgages, you can pay a high product fee and then you'll get a low interest rate. Or you can pay a low product fee, meaning the cost of that mortgage product may be $5,000, $10,000, $15,000 just to get that product. And you may pay that up front. And then that means that your interest rates for the overall deal is going to be lower. So when you're speaking to your mortgage advisor, an experienced mortgage advisor will say, don't just look at the rate, because if you're just looking at the rate, it may mean you're paying, in addition to your 25% down, you're paying a high product fee. You need to think about, do you want to make the most per month, or do you want just something that's going to cover the mortgage as far as your rental income? So these are the things that you want to consider as far as how much you pay down and what product you decide to get. I hear people ask, and I usually have to explain what a consumer buy-to-let mortgage is. So a consumer buy-to-let mortgage is a little bit different than a traditional buy-to-let mortgage. A consumer buy-to-let mortgage is designed for people who didn't originally intend on becoming landlords, but they now need to rent out the property. When I was doing my exams, the tutor always called it an accidental landlord. So maybe, you have a family home that you inherited, and then you decide that you're going to buy another property. So you own a property that you inherited, and then you want to buy another property, but you want to retain the inherited property. So you would then be turning that into a buy-to-let, but it would be a consumer buy-to-let. The property, as I said, could be inherited. Someone might also need a buy-to-let mortgage if they've moved in with a partner. This happens a lot when people are getting married or people are going to be living together. One or both of the people may actually already have a mortgage on a residential property, and instead of selling that property and then cohabitating, they want to retain the property that they had originally and rent that out. That would be considered a consumer buy-to-let. There are some drawbacks to consumer buy-to-let, but there are also additional benefits because you get additional protection. Some of the hurdles that you need to consider when you're looking at getting a buy-to-let as a first-time investor, you're going to need to think about the deposit, because you may be thinking in the terms of a traditional residential mortgage. So you might be thinking, oh, I can get away with a 5% deposit or a 10% deposit. But as I've said, you're usually going to need a much larger deposit. Credit issues. Although one of the big differences between a buy-to-let mortgage and a residential mortgage is the buy-to-let mortgage is a lot more dependent on the property you're buying and the ability for that property to generate money or income. Believe it or not, there are buy-to-let mortgages that you can get where they don't even need to see or verify your income to a degree. There are buy-to-let mortgages that you can get without an income, because remember, the loan is secured against the property. And if you're getting a property that the bank feels is worth what you say it's worth, and it can generate, as a rule of thumb, about 45% more than the mortgage, then they're happy to lend, even though you may have no income or a low income. One of the things that banks will look at, though, is, are you a first-time buyer, first-time landlord? So what that means is you don't have a residential mortgage, you've never had a residential mortgage, you'd be considered what they call an inexperienced landlord. Some lenders will lend, some lenders won't lend. It is easier if you've had a residential property or you have a residential property and you are then looking to purchase a buy-to-let property. One of the reasons that the banks will look at that is because you do have people that abuse the system. So they will purchase a buy-to-let property and then live in it. Now, why would someone do that? Yes, you have to pay down a higher deposit, but because the threshold and some of the criteria is a little bit easier for getting the buy-to-let property in some senses, some people will do that. I will say this, like I always say this: honesty is the best policy. There's a product for every person. It's best to do things the right way, because if you take out the wrong mortgage or if you abuse the mortgage that you have, you can not only put yourself in financial issues because it may violate the insurances that you may have on the property, but you could also put yourself in some very serious legal problems. So speak to a broker, and if a broker is telling you the right thing to do, don't ghost that broker and find a broker that tells you that you can do something that they know you shouldn't be doing. Do the right thing. There's a saying that we have in the States where we say, when you try to cut corners, you end up buying them. So in the short term, you may feel that you've benefited. But in the long term, when you go for a remortgage or when you're trying to situate your properties, you may find that you run into problems because you took it out as a buy-to-let mortgage. It's clear that you're living in there and you violated the terms of the mortgage. The other thing that may cause a problem for you is if you're doing a buy-to-let mortgage and you're going to have a friend or family member in there. The friend you can kind of get away with because you're not related. But one of the questions that the lender is going to ask is, are you going to have a family member living in the property? Now, you might wonder, why would that be a concern? I think they see it as more of a risk if you have a brother or a sister or a mom or an aunt or an uncle living in the property, simply because if you run into problems with them paying the mortgage, it's a lot more complicated with a family member than it is with a stranger. And you want to make sure that you have the right tenancy agreements in place and you have a support network of people that can assist you with drawing up contracts. Don't go online and download some silly template as far as the agreement, the lease agreement that you have with someone renting the property. Spend the money. If you want to make money, you have to spend money. So don't try to cut corners and get some type of rental agreement that you found online. Go to someone who will look at your situation and put clauses in there that protect you and are in line with the current regulations that are always changing. What things do you need to consider when you're thinking about buying a buy-to-let property? First and foremost, you should have someone that's assisting you. We have some great people in our WhatsApp group that can assist you. These are reputable people. that aren't there just to sell a course. These are people that will walk you through the process and almost talk you out of it before you get started, because they want to make sure that you're committed. They want to make sure that you're not in it just for the money, because the money will come, but the money does not always come as quickly as some people believe that it will. So many of you people watching will know Muzzy. Muzzy is a great coach. He has a great program, and he can assist you not only with the buy-to-let thing, but also with some other rent-to-rent schemes, other ways of generating money, because you want to be creative when you're thinking about how you're going to start your property investment journey. You want to think about maintenance. So you might go out and buy a house on the cheap, fix it up, and then rent it out. But remember, unlike when you're renting your property and the landlord takes care of all the maintenance, you're now the landlord. So you're now responsible for maintenance. And what a lot of people will do when they don't want to pay their rent, they'll complain about different things in the property. So you want to make sure that you maintain the property well. You want to make sure that you operate within the guidelines and the regulations, not only for the country, but for your council. Think about your tax rate as well, because when you're getting the mortgage, one of the things that the lender will ask the broker is this person a high rate taxpayer? Because if you're a high rate taxpayer, it will impact what they call the stress testing. The stress testing is essentially looking at how much the mortgage is versus how much the rental income is. And as I said, as a rule of thumb, you want it to be around 45% higher than your mortgage. You also want to consider your exit strategy. A little bit later, what I will be talking about is different types of mortgages and the way that you repay them. But your exit strategy is, what do you do at the end of the term? Are you going to sell that property? Are you going to pay off for the property? Think about your exit strategy. Are you going to put this in your estate for your kids to inherit? What are you going to do? Because on the mortgage application, this is actually one of the questions that the lender is going to ask. What is the person's exit strategy? I get asked this question a lot, so I cover it off a lot. Should I buy an auction property? My first answer to most people that are asking that question would be no. Do not buy an auction property. And if you're asking me if you should buy one, it's probably because you're an inexperienced buyer, you don't have the right network, and you don't understand all of the risks that come along with buying an auction property. Think to yourself, if you see this property that you would feel is worth 500,000, but they're selling it for 200,000. Obviously, there's a reason why they're selling it for 300,000 pounds less than what you think it's worth. So if you're not an experienced investor, if you're not someone that has cash to lose potentially, or the right team of people that can go in and get that property ready either to be rented or for you to live in, if you don't have those things, just avoid the auction property thing. Okay, I'm not saying that there haven't been people or aren't people who buy auction properties and are very successful, but they tend to be people who have a good support network, understand how this process works, or they are people that have a lot of cash, so they are cash rich. You have to think about it with a mortgage, with a auction property. If you don't have the cash to buy it cash, you're going to need to get a mortgage. And you need to complete on that purchase. Once your bid is accepted, you need to complete on that purchase within 30 days in most cases. And you'll have to pay a deposit up front. If you're unable to get a mortgage, you don't get your deposit back. So they will have you sign a lot of legal disclaimers. And I, as a broker, if I'm going to support someone that's inexperienced or experienced with an auction property, I make sure that they sign off on the disclaimers. You are required to get independent legal advice because your deposit is at risk. So you want to make sure that you know what you're getting into. So if you know what you're doing and you're an experienced investor, then yeah, an auction property could be a great way of getting a property below value that you can then increase the value and either rent out or flip. But if you are inexperienced and you just think that this is just a gift from God, that this £500,000 house they're selling for £200,000, you're probably going to have a very, very unpleasant surprise. Another question that people ask is, should I buy through a limited company? Some people will buy properties through limited companies, and there's pros and there's cons to that. I am not an accountant. I am here as a mortgage broker to tell you how mortgage products work. If you're considering buying a property through a limited company or setting up a limited company to purchase property, always speak to an accountant who specializes in property. Not all accountants are created equally. So make sure it's someone that understands the property market, someone who understands what your long-term goals are. As with any professional, you've got to be open and honest. You've got to be open and honest with your professionals in order for them to assist you. So if you don't feel that you can be honest about the outcomes that you're looking for, or maybe some of the challenges that you're facing, then you're working with the wrong person, because they're not going to be able to give you the best advice if they don't have all of the information. So you want to think about your long-term goals. You want to think about, well, is this something that I just want to make some money and then when I retire, sell it because it will have appreciated? Do I want to put this in my estate? These are the things that you're going to want to discuss with the accountant. And another thing to consider is what they call the SIC codes, the SIC codes. Because when you're purchasing through a limited company, lenders will ask what SIC or SIC codes are associated with that limited company. And this is important because some lenders need to see that the SIC code for that company is specific to property. So for example, if you are a carer or you have a care business, or you're an accountant and you have an accountancy and you run that caring company or accountancy through a limited company, it will have a SIC code that is relative to that. It's not a property SIC code. So some lenders will not lend to a limited company that does not have the appropriate SIC codes. Or some will need to see a specific SIC code because there's different SIC codes that relate to property depending on how you're going to use it. But if you speak to an accountant who specializes in property, they'll be able to talk you through all of that and make sure that your long-term goals meet the SIC code that you put on that limited company. What are the different types of mortgages? As an adult, you probably hear people talk about fixed, variable, tracker. You hear people talk about all of these things all of the time. And if you're like probably 40% of the population, they don't really understand what it is. And I'm not just talking about 40% of the general population. This includes people who have mortgages. I know lots of clients who, when I start to unpack what these things are, and they're doing a remortgage, their previous broker never even spoke to them about these things. So a fixed rate mortgage, it will be a mortgage where you know how much you're paying each month for an agreed period of time. The most popular fixed terms are 2, 3, and 5. That's not to say that you couldn't get a product that is 4 or 7 or 10 or 12, but most of the products are grouped around a 2-year fixed, a 3-year fixed, and a 5-year fixed. If someone's taking out a 2-year fixed term mortgage, it's usually because they feel that interest rates are going to be dropping within the next 2 years. If someone takes out a longer, like a 5+, it's because they think that interest rates may be going up. The fact that you fixed it means that for that period of time that you fix it, your payments are always the same, regardless of what the Bank of England does and lenders do with rates. But keep in mind, there is something called fixed rate risk. And that means if you, let's just say right now, you say, you know what, I think interest rates are going to continue to go up. So I'm going to fix my mortgage for 10 years. At the recording of this video, it's 2025. So you fix that mortgage for 10 years until 2035. And we have a situation where interest rates just drop and drop and drop and drop and drop and drop. In that 10-year period, you won't be able to access those rates because you're fixed. If you want to get out of it, you will have to pay what's called an early repayment charge, so an ERC, early repayment charge. That's the bank penalizing you for paying off your mortgage before the term that you agreed. You can do it. So let's just say you win the lottery and you decide, you know what, I don't want a mortgage anymore. I'm going to pay off my mortgage. You can do that. But the bank is going to say, well, you promised to pay for 5 years or 2 years or 3 years or 5 years. And therefore, we are going to penalize you. So in the first year of a fixed rate, the ERC or early repayment charge is going to be higher than towards the end. A variable rate is just that. It's going to vary. You can have a tracker that will track the Bank of England base rate. But we're here to talk about buy-to-let mortgages. So the two type of repayment strategies are what we really need to look at. You have a repayment mortgage. So a repayment mortgage means essentially you take out a mortgage for £500,000. Every time you make a mortgage payment, the amount you owe goes down a little bit. So you pay part interest, you pay part repayment. So the balance that you have goes down and down and down and down and down. We were talking about fixed terms. The other term that you need to understand is the overall term on a mortgage. That's the big number. So that's I've taken out a 25-year mortgage or a 30-year mortgage or a 15-year mortgage. So you could take out a 15-year mortgage and fix it for 2 years. Or you could take out a 15-year mortgage and fix it for 5 years. So the fixed term and the overall term are two different things. If you have a repayment mortgage, it will mean that in your overall term, let's just say it's 15 years, in your overall term, when you get to the end of that 15 years, you'll have a zero balance because you'll have paid off the full thing. Most people with buy-to-let mortgages will do what's called interest only. And it does what it says on the tin. An interest-only mortgage means every time you make your payment, you're just paying interest. So the initial amount that you borrow will always be what it is. So if you took out a £500,000 buy-to-let mortgage and you're paying, let's just say, £1,000 a month for 20 years, after 20 years, you will still owe £500,000. So this brings us back to what I was saying about the exit strategy. The bank will expect at the end of that term for you to pay off that full £500,000. Usually, when we're doing a buy-to-let mortgage for people, most people, their strategy is to sell the property. And we're going to explain why when we get into the scenarios. Don't forget, if you have questions, you can put the questions in the chat. Happy to answer your questions. That's why you're here. So what is the mortgage process? Some people listening may already have a mortgage, and so therefore they may understand the process. But for those of you who don't understand the process, first things first, speak to a broker. I, as a rule, tell people to speak to a broker at least 6 months before you even need their services, because then they can do a financial assessment, they can give you a blueprint, they can give you a plan that when you're ready, all of the silly things that you may need to do, like canceling direct debits or tidying up your credit profile, you'll have done those things. It really hurts my heart when someone comes to me and they've done the right thing as far as saving, and they've come to me and they're like, I'm ready to get a mortgage. And when we go through their credit profile, I'm like, wow, you missed the payment 3 months ago, or you missed the payment 2 months ago. That's going to impact the lenders that will lend to you. So speak to your mortgage broker 6 months in advance of when you're ready. They can do an affordability assessment. But if you're looking to get a buy-to-let mortgage and you've done your research and you put your ducks in a row, the next step will be to get an agreement in principle. I talk a lot about agreement in principles because they're super important, but they're super not important. An agreement in principle, when done correctly, will give you an indication of what a bank will lend to you as an individual. The reason why I stress what they will lend to you is because they may want to lend £500,000 to you for that buy-to-let property, but when you find the property, that property might not be suitable for them to lend on that specific property. But we'll get into that in a few more minutes. So we'll get you an agreement in principle. The agreement in principle will tell you how much you can afford, and you'll go out, you'll find the property. Please work with someone like Muzzy or someone that you know that's going to help you find a suitable property. Make sure you have builders. Make sure that you have a good team that you can find the right property. Once you find the property, you're going to negotiate. I offer a free negotiation service to my clients, meaning I will get you the very best price. I do this every day. I've been in finance for 30 years. 100%. I can negotiate better than you can. And certainly you're not going to be able to negotiate as well as an estate agent because they do it every day. So why not put me as a professional up against another professional rather than you try to do it and you end up spending more than you have to. Once we get an offer accepted, you'll also want to instruct a solicitor. You should start looking at solicitors well in advance of this stage, but this is the point that you're going to instruct a solicitor. Then we'll do what's called a full mortgage application. That's when we're submitting all the information. We are verifying that you have your 25% deposit to the bank. We're verifying what tax rate you're on. We're verifying that no family members are going to be living in the property. This is the stage where we're filling out the formal application. The bank will then do a valuation. The purpose of the valuation is to ensure that the bank feels and is confident that the property that you're buying is worth what you're paying for it. I'll say that again. The bank will go out and do a valuation to make sure that that £500,000 house that you're buying, that the seller has agreed to sell for £500,000, they want to make sure that they feel it's worth $500,000. So they'll do what is called a valuation, and it's what they say that counts. Once they've done the valuation, they'll do underwriting that can take about a week or 2 weeks, depending on your profile of the property. And then they'll give you a formal mortgage offer. The formal mortgage offer is now them saying, yes, we want to lend to you, Mr. Customer, and yes, we will lend on that specific property. That mortgage offer is usually good for 6 months or so, but it can be extended. Then your solicitor will work with the seller's solicitor to do searches. You can then opt to do a RICS survey. So a RICS survey is where they go in and they give you more detail. This is you doing this, so you pay for it. They give you more detail than the bank valuation, where they just give you a copy of the valuer report. You can do that earlier in the stage, but I think it probably is worth doing before you get the offer, that if you want to proceed. But certainly if you're going to do any type of survey, you want to do that at the point where all of this stuff is going on. Then you'll get an exchange date. Then you'll get a completion date. If anyone has any questions, please put the questions in the chat. So I'm going to go through 3 case studies. Then we'll be all set and we can answer any questions you have. So as I said, quite often, when people get married, one or both of the individuals may have owned a property. So you will have 2 people coming together, one or both of them own a property, and they decide to get a buy-to-let mortgage. But if you recall what I said, this would be considered a consumer buy-to-let mortgage. So it's not a standard buy-to-let because one of them has already lived in the property. So it's a consumer buy-to-let. They now want to buy together, so they're going to purchase another property, rent out that existing property. Let me clarify that a little bit better. So the property that they had before they got married, they're going to convert that into a consumer buy-to-let. And then they'll go on and purchase a residential property. So just think about it this way. Man and woman come together. Woman has property. They then decide that they're going to buy somewhere together. She converts the existing property that she had, that she used to live in, into a consumer buy-to-let. They have that property. And then they get a mortgage for a residential property. And in most cases, they could decide whether they want to do it interest only or if they want to do a repayment mortgage. In this case, just to make it more affordable, they may go for an interest-only mortgage, especially if they are a little bit younger. Case study number 2, and this is one that I do see quite frequently, especially because a lot of younger professionals want to be mobile. They don't want to be tied to a specific city and maybe not even to the UK. So they're not looking for a residential property due to their career aspirations. They are a good income. They have a high deposit, so they'll be able to get over that 25% deposit threshold. They have a solid network of experienced investors or builders. So they're like, look, I've just got qualified as a doctor. I've saved up money, or my parents are giving me money, whatever. I don't want to buy a property to live in. I'm okay renting, or I'm okay staying at home. But I do want to start to build up a property portfolio. So I'm going to go out and buy a buy to let property. I'm not going to live in it. I'm going to rent it out. They have a network, or they're in our network, and they know experienced investors, experienced builders that can guide them to find the right property. In this case, usually they're going to want a standard buy to let mortgage, interest only. If they're in their early 30s or mid 30s, they could take out a 25, 35-year mortgage, interest only, and there's a lower risk at that age, because if they're taking out a 35-year mortgage at 35, that takes them to 70. If they're doing interest only and they're getting the right yield, meaning their mortgage payment is £1,000 a month, let's just say, but they're able to rent it out for 2,000, so they're making 100% on the mortgage repayments. That £1,000 that they make per month minus maintenance, let's just say, but let's just say it's 12 grand a year. 12 grand a year over 35 years is money they made. In addition to that, over 35 years, that property will appreciate. It will grow in value. So at the end of that term, when the lender says, we want our money now, that person has the option to sell it, pay them back the initial amount, and walk away with profit on the sale, plus the money that they made over the last 35 years. So I do find that you do have individuals that are younger, they are starting their career, they want to be able to move to the US or move to Dubai, but they want to start a property investment portfolio. They would take out a standard buy-to-let mortgage, and usually will do it interest only. They could do repayment, but usually at that age, they would do a interest only. Case study number 3 would be an older couple. So this older couple already have a residential property. Their kids are grown. They've paid off the mortgage, and they're not at retirement. You know, they might be in their 50s, and they decide, look, I want to build generational wealth. We have this property that we've already paid the mortgage off. One of our kids or several kids are going to split this property, but I want to build something else. I want to have something for my children's children. So they say that they're going to buy a buy-to-let property. Let's just say they're 50, just to make it a little bit easier. So they don't have high overheads because they've already paid off their residential property. And most older people, they have the things they want. They don't waste money. So they have low overhead. So no mortgage. They both have good salaries. They've been at their job for a while. They're good at their job. They have stability. They're looking to create generational wealth by buying an additional property. They've built up a good pension. So when they retire, they might be fortunate enough, like when I was at Lloyd's, when they were offering final salary pensions. So their finances are fine. What they would usually do is they would get a standard buy-to-let mortgage, but not on interest only. So if they're in, 50, 55, they might say, well, I'm going to take out a buy-to-let mortgage, buy something up north that's inexpensive. I'll pay down the 25% because we have the savings. They may even take equity out of their residential mortgage, but it would be better if they just use their savings. They then buy something up north, pay down the 25%, so they have a really low mortgage payment. And then at the end of that 25 years or 30 years or whatever, they have paid down that full mortgage because they didn't do an interest-only mortgage. They did a repayment mortgage. So now at the end of that period, they've retained the residential property that they had, and that's appreciating in value. They now have the second property that is paid off. They end up with 2 properties. And who knows, they may do that multiple times. So these are the scenarios that I tend to find when people are looking at getting a buy-to-let mortgage. These are the reasons why someone would look at it, but usually people are hesitant because they don't understand how the mortgage works. That's why I'm covering this off, because I want to make sure that you have access to good information without feeling pressured. Quite often people approach me like, oh, I want to ask you questions, but I don't want to waste your time. So these videos are hugely useful, and there's something you should share with friends and family. Don't forget to like, share, and subscribe. I'm happy to answer any questions that anybody has, either now during the podcast, or you can always contact me by looking at the description and getting my contact details. Always happy to talk, always here to help, and I'll always do my best to answer your questions. If I don't know the answer, I will always just tell you I don't know the answer, but I'll go away and find it for you. I'll always be open and honest with you. Quite often, I do have to tell people that what they don't want to hear, but I will also always make sure that I'm giving you the best advice to ensure that you and your family are protected, that if you buy a home, if you purchase a buy-to-let property, not only will you be able to buy it, but you'll be able to keep it. I will say with that, interest-only mortgages, if you don't have a solid exit strategy, can be very risky. Over the years, I've come across a lot of people that, wanted to get on the property ladder and they went and got an interest-only mortgage. It's now come to term and they're too old to get a reasonable mortgage. In other words, they don't have the income to support a mortgage. But equally, they need to pay that money back because it's come to the full term and the bank is saying, listen, we need our money. We loaned you money 15 years ago and you've been paying us every month. Thank you for that. But you were only paying the interest. The full mortgage is now due. So we want to make sure that we put people in the right position. We give people the best advice. Share this with friends and family. And unless you have any questions, that's it. Be sure to like and subscribe. Be sure to let people know about the channel.